Hello everyone, I'm Dr. Ramandeep Kaur, Faculty, Department of Commerce of Bhopal School of Social Sciences, and I'm here to discuss a very important topic of financial accounting, that is final accounts. Now in this video, we are going to understand the introduction to final accounts, meaning of final accounts, objectives of final accounts, formats of final accounts, and the different adjustment entries and their accounting treatment. So first of all, what are final accounts? As we all know that accounting is the art of recording, classifying, summarizing and interpreting the financial transactions. Recording is done with the help of journal, classification is done with the help of ledger, summarization is done with the help of trial balance and interpretation is done with the help of final accounts. So final accounts are a very important tool to interpret the results of the business, to interpret the financial statements. So what are final accounts actually? The definition says that final accounts refer to the various accounts and statements that provide information related to the progress of the business. That is, final accounts are the accounts that help you to understand the progress of the business. They help you to understand the results of the business. Now, final accounts are the statements that are prepared from the trial balance. Trial balance is the base to prepare final accounts. Then actually what are the different accounts and statements that comprise under final accounts? Final accounts comprise of two accounts and one statement. First is the trading account, then we have the profit and loss account, and then we have the balance sheet. Now together, trading account and profit and loss account are known as income statements, and income statements are actually the statements that provide the final summary of the accounts that affect the profit and loss position of the business. Now let us understand what are the objectives of final accounts. Why actually we prepare final accounts? So the first objective of preparing the final accounts is to know the results of the business. With the help of final accounts, you are able to calculate the results of the business. You are able to understand whether your business is earning profit or your business is earning losses. And if your business is earning profit, what is the amount of profit that is being earned by your business? And if your business is earning losses, then what is the amount of loss that is being earned? So all these things, the results are calculated with the help of final accounts. The second objective of final accounts is to know the financial position of the business. Now there is a very important statement that helps us to understand the financial position of the business, and that is the balance sheet. If you want to understand the financial position of the business, it can be understood from a statement, that is balance sheet, and with the help of balance sheet, you could understand the position of your business in terms of its assets and liabilities. That is, what is the total amount of liabilities that the business have, and are the assets sufficient to pay off the liabilities or not. So with the help of final accounts, you could know the financial position of the business in terms of its assets and liabilities. Then the third objective of final accounts is that it assists the managers to take decisions about the business, or it assists in managerial decision making. The results that are being given by the final accounts helps the managers to take decisions about the business. They interpret the results of the business. Based upon those interpretations, managers take decisions about the business. They help to understand what are the areas of deviation. If losses are earned by the business, how can we convert those losses into profits? And if profits are there, how can those profits be further increased? So to take good decisions about the business, the adequate decisions about the business, these final accounts are very important. Next is, the next objective of final accounts is to avail loans from banks or financial institutions. So final accounts are actually very important documentary evidence that can be produced in the different banks or financial institutions, and you can take credit facilities, you can avail credit facilities by producing these documents, because they help to by studying these documents, the banks can understand your financial position till date. Next objective of final accounts is to assess the income tax. Now, tax is calculated on the total income. Total income you can understand through your income statements or your profit and loss account. So, when you prepare the final accounts, you are able to calculate the results of your business, you are able to calculate the income of your business, and based upon the income, the tax is being paid to the government officials. Next is, it provides information to the different users who are interested to study your books of accounts. Now, there are different users who are actually interested to study your financial statements. They want to understand the results of your business. These users are in the form of your shareholders, the different type of investors, banks, financial institutions, they may be the creditors, the government agencies, they may be the employees. Everyone is interested to know how the business is performing. So, the performance of the business can be known through your final accounts. So, that is the reason why business prepares these final accounts to provide information to the different users of the accounting information. Now, after the objectives, let us understand the first type of final account, that is trading account. Now, the basic objective to prepare trading account is to know the gross profit or gross loss of the business. Then it is a type of nominal account. We know that nominal accounts are the accounts that record all the expenses and the incomes. So, since trading account is a type of nominal account, therefore it records all the different type of expenses and your incomes. Then when the trading account is recording expenses, what kind of expenses are recorded under trading account? So, under trading account, you record all the direct expenses. What do you mean by direct expenses? Direct expenses are those expenses that are responsible to make your goods into sellable condition. They are actually your manufacturing expenses. So, manufacturing expenses are recorded in your trading account, that too at the debit side. Then on the credit side, you will have the sales and the closing stock balances. Now, the end result of the trading account, you can interpret the gross profit. So, if sales are greater than cost of goods sold, you will get gross profit, and if cost of goods sold are greater than sales, you will get gross loss. And if you want to calculate cost of goods sold, how to calculate cost of goods sold? What is the formula? Opening stock plus purchases plus direct expenses minus closing stock is the formula to calculate COGS, that is cost of goods sold. Now, you will see the format of the trading account. Now, trading account is an account that is always prepared for the year ended so and so. It records the income and expenses for the entire year. And as we have discussed, on the debit side, we have all the different types of direct expenses, like we have wages, we have custom and import duty, then we have carriage expenses and royalty, manufacturing expenses. All the direct expenses are there in the trading account. At the credit side, we have net sales figure, that is sales minus sales return. Then we have closing stock and the end result. If the credit side is greater than the debit side, the result is gross profit, and if the debit side is greater than the credit side, the result is gross loss. So, this is the format of the trading account. After the trading account, the next very important type of final account is your profit and loss account. Now, what is the objective to prepare profit and loss account? The objective to prepare profit and loss account is to calculate the net profit or net loss of the business. Now, it is again a type of nominal account, that is again it records the expenses and incomes. Direct expenses goes to trading account. So, what are the expenses that come under profit and loss account? All the indirect expenses are recorded in your profit and loss account. If we talk about the indirect expenses, what are the different types of indirect expenses that are recorded in your profit and loss account? The different type of indirect expenses are like your office and administrative expenses, selling and distribution expenses, and different type of miscellaneous expenses are a part of your profit and loss account. So, debit side all the indirect expenses, and credit side you will have the different incomes. So, this is the format of your profit and loss account. Again, profit and loss account is prepared for the period ended so and so. That is the reason it records the expenses and incomes for the entire year. And also the gross profit that is calculated in the trading account is brought down at the opposite side, that is at the credit side of the P&L account. Then we record at the credit side all the types of different incomes, that is interest received, commission received, discount received, profit on sale of shares. They are recorded at the credit side. At the debit side, we will have all the indirect expenses, or you can say the office and administrative expenses of selling and distribution expenses like salaries, rent, commission paid, advertisement expenses, bad debts, discount. These are few examples of your indirect expenses. And if again in your profit and loss account, the credit side total is greater than the debit side total, the result is net profit. And if your debit side is greater than your credit side, the result is net loss. So the objective we have understood that the basic objective to prepare trading and trading account is to know the gross profit or gross loss of the business. The objective to prepare profit and loss account is to know the net profit or net loss of the business. Now, here are few examples of indirect expenses that you will find under profit and loss account. Few examples we have discussed. There are few more examples like under selling and distribution expenses, you will have packaging expenses, warehouse rent, delivery van expenses. Then you have selling agent expenses, carriage outward, bad debts, sales tax, export duty, all are a part of selling and distribution expenses. Then office and administration expenses comprise of office rent and rates, telephone expenses, legal expenses, audit charges, office lighting, printing and insurance. Then you have certain financial expenses also under your profit and loss account, that is interest on loan, interest on overdraft, interest on capital, bank charges, discounting of bills. Then there are certain miscellaneous expenses that are also recorded at the debit side like repairs and renewals, donation, charity, loss due to accidents and depreciation. And the revenue receipts, that is the item of the credit side for the P&L account, will comprise of bad debt recovered, commission received, interest received, profit on sale of fixed assets, interest on drawings and income from investments. End result we have already discussed, that is to calculate the net profit or net loss of the business. Now the third type of final accounts is your balance sheet. Now remember, balance sheet is not an account, it's a financial statement. Since balance sheet is not an account, therefore it does not have a debit side and a credit side. But of course it has two sides. The two sides of the balance sheet are your assets and liabilities. The right hand side of the balance sheet is the asset side and the left hand side is the liability side and the capital side. Now why balance sheet is prepared? Balance sheet is prepared to know the financial position of the business in terms of assets and liabilities, and then balance sheet is prepared, always prepared on a certain date. This is again a very special characteristic of a balance sheet, that it helps us to understand the financial position of the business in terms of assets and liabilities on a particular date, that is on the year end. 31st March so and so. On 31st March, what is the financial position of the business? Not on 30th March, not on 1st April. Specifically on 31st March, what is the position of the business in terms of assets and liabilities? We get to know with the help of balance sheet. Then when we prepare the balance sheet can be prepared in the order of liquidity or in the order of permanence. When we prepare the balance sheet in the order of liquidity, we write down the liquid assets or current assets first and the current liabilities first, followed by the fixed assets and fixed liabilities. And when we prepare the balance sheet in the order of permanence, we write down the permanent assets, or you can say the fixed asset and fixed liabilities first, followed by the current assets and current liabilities. So you will find an example of the balance sheet. First of all, balance sheet is prepared as on a particular date. Right hand side is for the assets, left hand side is for all the liabilities. Now this balance sheet is prepared as per the order of liquidity. So you will find the current assets and current liabilities first. Liability side you will have all the current liabilities first, that is bank overdraft, outstanding expenses, bills payable, creditors. This is followed by the long-term liabilities, that is long-term loans, and finally the capital. And whichever order we are following at the liability side, same order will be followed at the asset side as well. Like if we have started with the current liabilities, asset side will start off with the current assets. So current assets we have cash in hand, cash at bank, prepaid expenses, bills receivable, sundry debtors, closing stock. This is followed by few of the fixed assets like plant and machinery and land and building. So this is how the balance sheet is prepared. Now we have discussed how to prepare the trading account, we have discussed how to prepare the profit and loss account, what is the objective to prepare the trading and profit and loss account, and then we have discussed what is a balance sheet and how a balance sheet is prepared. Now, in certain questions related with final accounts, you will find certain adjustments that are given. So, what are the different adjustments that are there under final accounts and how their accounting treatment is done? Let us understand these adjustments and their accounting treatment. Now, a first very common adjustment that you will find in the questions related with final accounts is the closing stock. Closing stock is the stock that you will find always outside the trial balance. The stock that is given inside the trial balance is generally your opening stock. Closing stock you will find outside the trial balance, and anything that is given as an adjustment outside the trial balance will always have two effects. So closing stock is always given outside the trial balance. Therefore, the two effects of closing stock is, first, it is shown at the asset side of balance sheet, and second is it is shown on the credit side of trading account. Next important adjustment is related with outstanding expenses. Now, what is the meaning of outstanding expenses? Outstanding expenses means expenses due but not paid. They are due but they are not paid, but they will be paid in the current year, within one financial year. Outstanding expenses are the expenses due but not paid, but they will be paid within one financial year. Therefore, they are your current liabilities. So, if outstanding expenses are given in the trial balance, so there will be one effect where it will be on the liability side of balance sheet. And if outstanding expenses are given outside the trial balance, then there will be two effects. The first effect will be, it will be shown on the liability side balance sheet, and the second effect will be, it will be added to the respective expense in the trading and profit and loss account. They are to be added. Remember, outstanding expenses are the expenses that are to be added in the respective expense in the trading and profit and loss account. And the second effect is that since they are your current liabilities, therefore they will be shown in the liability side of balance sheet. Next are your prepaid expenses. Now, prepaid expenses means the expenses that are not due but paid, or you can say the expenses paid in advance. Now, since they are paid in advance, therefore they are your current assets. If prepaid expenses are given inside the trial balance, then there is one effect, that is they will appear on the asset side of balance sheet. If prepaid expenses are given as an adjustment outside the trial balance, then there will be two effects of prepaid expenses. First is they will appear on the asset side of balance sheet, and second is they will be deducted from the respective expense in the trading and profit and loss account. Next is depreciation. If depreciation is given inside the trial balance, it will be shown on the debit side of P&L account, and if depreciation is given outside the trial balance, it will be shown on the debit side P&L and then deducted from the respective asset in the balance sheet. Next is outstanding income. Outstanding income means income due but not received, but this income will be received in the future, therefore it is your current asset. So, if outstanding income is given inside the trial balance, one effect will be, it will be shown on the asset side of balance sheet, and if outstanding income is given outside the trial balance as an adjustment, there will be two effects. First effect will be, it will be added to a particular income on the credit side of trading and P&L account, and second effect is it is shown on the asset side of balance sheet. Next is income received in advance. This is income not due but received. So till the time the service is provided, this is always treated as a liability. So if income received in advance is there inside the trial balance, it will come in the liability side of balance sheet. And if it is there outside the trial balance, the first effect will be, it will appear on the liability side of balance sheet, and the second effect will be, it will be deducted from the income in the credit side of P&L account. Next is interest on capital. If interest on capital is given inside the trial balance, one effect, it will come on the debit side of P&L account, and if it is given outside the trial balance, there will be two effects. First effect, debit side P&L, and second effect, it will be added to the capital on the liability side of balance sheet. What is the accounting treatment for interest on drawings? Interest on drawings, if it is given inside the trial balance, one effect, it will come on the credit side of P&L. If it is given outside the trial balance, then there will be two effects. First effect is, it will come on the credit side of P&L, and second effect will be, it will be subtracted from capital on the liability side of balance sheet. Next, bad debts. Very important adjustments. If bad debt is given inside the trial balance, it will come at the debit side of P&L. If bad debts are given outside the trial balance, first effect will be debit side P&L. Second effect will be subtracted from debtors in the asset side of the balance sheet. Provision for bad debts. If it is given inside the trial balance, it will come at the debit side of P&L. If it is given outside the trial balance, it will be shown in the debit side of P&L, and the second effect will be subtracted from the debtors on the asset side of balance sheet. So here are a few important adjustments that we have discussed. We will soon come with a new video on a different module, on a different topic. Till then, thank you so much. Have a good day.